So we're going to watch this video called I Analyzed 100 Years of Index Funds, and this is what I found. Now, for those of you who have been, somewhat interested in trading and investing, an index fund is probably the safest place to put your money. At least that's what everybody says, right? Buy the market, don't touch it. What do they say? Time in the market beats timing the market. Me and my portfolio and you outliers have proven it differently. You can absolutely time the market when you have the right data. But to most people, 95% of people out there, they don't want to be trading. They don't want to be active. They don't want to do anything except, every 2 weeks, automatically deposit it into their broker, into their mutual fund, into their IRA, whatever. But I think this video may contradict some of those points, which actually may go along with a lot of what we talk about here at Outlier. So I'm very excited to watch this. I analyzed 100 years of index funds, and this is what I found.
A chart like this one is probably the reason most of you invest, myself included. It's this long-term historical performance demonstrated by this lovely line upwards that kind of gives us the reassurance of returns in the future.
I know what markets are going to do over a long period of time. They're going to go up.
It's often repeated that past performance like this is no guarantee of future returns. But today I hope to show you really that when it comes to past performance, that's not even a guarantee of, past returns.
Dude, the video quality of this is on point. I'm excited.
I want to start by coming back to this chart. It was compiled by a guy who works at Google and NASA, so yeah, must be good, right? But let's just add a few key dates onto this thing. March 1957, Standard & Poor's expanded its old index of 233 stocks to a newer list of 500 stocks. That's the S&P 500, but this chart is looking to plot the performance of going all the way back to 1871. But when they introduced the list, you still couldn't buy it at that point. You had to wait until 1976 before the introduction of the first publicly available index fund that tracked the top 500 companies was available to buy. So that's 100 years after this chart started. Okay, what about for people like me, global investors? MSCI published a world index covering developed market stocks on March 31st, 1986. I dug into their methodology. It's this massive document here. It basically outlines how they compile their indexes. And at the bottom, very last page, pretty much page 144, in suspiciously small writing, it says this.
The information may contain back-tested data. Back-tested performance is not actual performance, but is hypothetical.
Wait, what? Oh. So they're showing you prospectus. They're showing you charts that may contain back-tested data. Back-tested performance is not actual performance, it's hypothetical. So it's not looking at an actual chart, right? Now, we talked about this in Outlier University just the other day. What is the stock chart? In my opinion, a stock chart is a history book of what has happened, right? What's really cool about this is I can zoom out and I can go all the way back to the COVID crash, right? So that was just a couple of years ago, right? There's the COVID crash. And then I can even go back, what happened in the dot-com? No, what happened in 2008? I can see what happened in 2008. I can go back even further and I can say what happened in the dot-com bubble, right? That was right here. And I could go back even further and say what happened in the 1987 crash, right there. Isn't that cool? A stock chart is a history book. But what he's talking about is saying that they have something different in these prospectuses, I suppose. Okay, let's continue on.
There are frequently material differences between back-tested performance results and actual results.
You'd think that market returns were just facts, wouldn't you? That what we're told was the return for any given year was set in stone. But here's MSCI saying that, going backwards, that's just not the case. So the question is then, what sort of witchcraft are they using to go back and calculate all of these returns? This right here is what I would call the gold standard of stock market returns data. So it was compiled by Dimson, Marsh and Staunton, and it goes back 125 years. And they rigorously try to put together what they think the global stock market has done for 5 different asset classes. I'm going to say it up front, this work here is excellent in my opinion. In an interview in 2017, Dimson said this about why they started compiling their data.
We were initially interested in creating an asset return history for the UK. We didn't trust the then standard data series for long-term UK investment returns. When we recollected the data ourselves, the previous study was very misleading.
Misleading is a strong word when it comes to compiling stock market returns, isn't it? But once you dig into some of the ways that they compile their data, I think you might agree with them.
When looking at a given group, you focus only on examples.
Dadgum, like this video quality is off the charts. Ain't nobody got time to make all this video quality if you're putting out videos twice a day. This is fantastic.
Successful individuals.
In the 80s, there was this study into cats, specifically ones that had fallen from buildings. It's a weird thing to study, right? But they looked at vet records and they found something that was pretty surprising. The cats that had fallen from 6 floors or above had less injuries than the ones that had fallen from lower down. Second floor jumpers. To the scientists, the explanation for this was simple. Cats that fell from higher heights had more time to react, more time to brace for the landing. But there was a flaw in this thinking. Who is taking a dead cat to the vet? The truth was, the majority of cats falling from 6 floors and up died on impact. Only a lucky few survived with minor injuries. Those are the ones that made it to the vet, and as such, they influenced the data. This is literally a form of survivorship bias. And we see this in the way that market data is reported as well. Dimson admits himself that compiling market data depends on surviving investor records. But before the Securities Exchange Act of 1934, companies weren't even required to report things like bankruptcies or mergers. Entire companies may have vanished, just lost to history because of this. We have no idea.
So I want to give a second story to this survivorship bias, and this is the one that I've always heard, is that during World War II, all these planes that would come back, you know, they'd fly in, land, the mechanics and engineers and everybody would look at the planes and they'd say, okay, look at all these holes in the planes, right? All right, so we need to put more armor plating on those areas that have all the holes. And then there was actually a statistician who looked at the situation, did inversion thinking. It's the way that they call it, inversion thinking. It was like, listen, if these planes made it back with all of these holes in them, those holes are fine. The problem is the areas that are hole-less, the areas that were not impacted by bullets, because if they came back, that means that they can fly with the holes in them. If they didn't come back, that means they were hitting areas that were critical to fly, meaning that all the areas that didn't have any damage needed the extra plating because those are the planes that didn't make it back. That makes sense? I think that's really interesting.
That they even existed. We only track the winners or the ones where there's records, so we get survivorship bias. Dimson, Marsh and Staunton have gone to great lengths to try and counteract this survivorship bias. They've done things like include failed markets like Russia in 1917. They even dig through old newspapers and archives, hunting for vanished companies. But what about the records that were just simply lost? When this chart specifically started all the way into the 1900s, where DMS measure, stock prices were quoted manually. People shouting and chalkboards. They were then relayed to other parts of the world using telegraph and ticker tape machines. How much of stock market returns history then is lost, forgotten, never written down? In times of war, hyperinflation and crisis, people might not prioritize keeping accurate records. And let's just not ignore the fact that there's high potential here for fraud or even lies. Just because someone wrote something down 100 years ago doesn't mean that it was true. In 100 years, is someone going to find this newspaper and be like, wow, these guys were really living life back then? DMS go further than anyone to combat survivorship bias. But you don't know what you don't know. And can we really trust what we do know?
It isn't worth the paper it's printed on.
I just want to bring you back to what Dimson said in his interview in 2017.
The previous study was very misleading.
It's that whole survivorship bias thing again. They've gone back in time to look at the returns, but they know which companies won and they only measured those companies. This methodology is flawed. DMS use peer-reviewed back histories for each country. So where they don't have data for other markets or countries around the world, they rely on other academics compiling that data.
Okay, so this is interesting. This reminds me of the survivorship bias thing he's talking about, right? So it sounds like, and this may be where he's going, is that they're only looking at companies that have survived, right? Which would make sense, but they're not looking at all the companies that basically went bankrupt, like were removed for the index. So imagine if there were 300 stocks back in the day, then it was moved up to 500. Not all of those 300 or 500 are still around today. So they might have been measuring only the ones that had survived during that time. So it may not have been 500. In fact, it probably looked something like, I'm going to draw, hang on. It might have looked something like this, right? This is what's called an asymptotic slope, meaning if you started at 500 I used to do this a lot with consulting, by the way, with credit unions. And this is what it would be like. In fact, I'll tell you exactly what I did. So we would look at their depositors, right? And let's say that at the credit union started with 500 depositors. And then over time, clearly a number of depositors would leave. This is facts, right? Every institution has people that are leaving period over period. And it's unlikely to ever go to zero from that original 500, but it's going to go towards zero given a long enough occurrence, right? If this is 50 years and you start at 500 people, the likelihood of 500 people still being there at the end of 50 years, impossible. But some people will be there. It may just be 5, and so you'd have like a 99% attrition rate. So over that time, you're dwindling it down, and so there is you could call it we would call it a decay rate or a mortality rate. And in this case, maybe that's the same thing here, is that while it started with 500 stocks back in, let's say, 1950, as we've gone from 1950 to 2025, not all 500 are still in there, right? And we hear this all the time, stocks being added to the S&P 500 and stocks dropping out. I think that may be where he's going here. I haven't watched the video, but it's going to be a huge survivorship bias if it's only measuring the ones that have survived over, whatever time period that they're looking at. Very interested to see this.
And the whole peer-reviewed thing means that other academics have checked that academic work and gone, yeah, we think this is rigorous and reliable. But even when it's peer-reviewed, there is the ability for human error to creep in. For this period of time here, if I just zoom right in, 1871 till about 1900, the expert on market returns is a guy called Alfred C. Cowles. His work focused on tracking the returns of railroads because this was the dominant sector back then. And his work in turn relied on the research from this guy, Frederick Macaulay, who was born in 1882. So you can already see there's a potential problem here. Research is often formed on the basis of other people's research. There's this chain of trust of information that potentially could form like a Chinese whispers effect. The work of Cowles is widely cited and referenced by loads of academics, but I stumbled across this paper called Did Cowles Get It Right? I found numerous excluded railroads and an assortment of errors made by Cowles and
excluded companies. That's exactly what I was thinking. Okay. This is such an interesting concept of a video. No wonder it's taken off like it is.
Macaulay. I also found a set of industrial firms excluded because of judgment calls that Cowles made. These errors were small, but the overall effect was to overstate market returns throughout the 19th century, and that completely changed the narrative around stock market performance throughout that time.
Stocks did not outperform bonds during the 19th century.
Scientists once believed that the Earth was the center of the universe, that humans couldn't travel over 30 miles per hour, that a computer would never beat a human at chess, and that ulcers, stomach ones, came from stress and eating spicy food. Then Dr. Barry Marshall drank a solution infected with bacteria to prove the real cause and won a Nobel Prize for it.
If I'd never won the Nobel Prize, I think I still would have been pretty satisfied about the discovery that we made that Helicobacter is the cause of peptic ulcer.
Look, I'm not saying that academics are wrong, many of which are Nobel Prize winners, but we constantly discover new things, change our understanding, debunk old wisdom. We even rewrite the rules.
The rules of the game change to fit the moment.
The Triumph of Optimists is the book that started all this dim sum Martian Staunton research off. Published in 2002, it covered 101 years of market returns, and at the time it focused on 16 markets. Today it's 125 years of returns, and they now look at 33 different markets. It's a testament to their rigorous data collection, but also a reminder of the global stock market problem. What is the globe when it comes to stock market returns? If your data leaves out countries, are you really measuring global performance? Before the 1970s, detailed stock market data was very limited, especially outside of the US. Even where indexes existed for a country, they often only track the biggest companies. It's like saying the S&P 500 is the American stock market. It's a pretty good proxy, but those 500 companies are only a fraction of the thousands of listed companies.
Right. And like at Outlier, we cover over 2,600 stocks. In fact, in the market breadth we're looking at here, my favorite one to look at is the full stocks list, right? You can see how many buy or sell signals are on the full stock list like this. Then you can zoom in a little bit and say, let's only go to the S&P 500. So you've gone from 2,600 or so stocks to around 500 or so stocks. And that's going to give a slightly different view, right? The law of averages really helps in this case because the more that you can get, the greater frequency of numbers is going to lead to better accuracy of results. And then you could go down to the Dow Jones, which you may or may not know is only 30 stocks, right? So you went from 2,600 to 500 down to 30. And that's going to give you vastly different numbers because 30 occurrences is significantly less than 500 or 2,600, right? So for me, I always go for the full stocks whenever I'm looking at data. You know, as much as I can get, that's what I'm looking for.
Companies that make up the total American market. When people talked about global stock markets in the past, they usually meant the US, UK, and Japan. A quick Google search tells me there are 60 major markets across the world, which is almost double again what DMS are tracking today. The data we have on a lot of those markets is pretty new as well, especially outside of the USA. You're looking at the 80s and beyond. And one thing that surprised me when researching all of this, the widely accepted way of labeling what sector a company falls into was only created in 1990.
By the way, there are only 11 sectors. I don't know if you knew that. Interestingly enough, that's exactly what's plotted on here. That was something I actually manually counted one day. I was like, how many sectors are there? I counted all 11. But whenever I'm looking to trade a stock, right? And we talk about this all the time. In fact, in our Outlier 9, give me just a moment here to pull up my slides on that. And I got this concept from one of the market wizards, Steve Cohen, right? He talks about how whenever you're looking for a stock, 40% of the stock's move is due to the market. Is the market rising? That's what you want to see. Are we in a bull market or are we in a bear market? If you're trying to buy a stock as the market's pushing up, it's so much easier than buying the stock as the market is weighing it down. And then the same with the sector, right? The 30% of the stock's move is due to the sector. Because if the market's strong and then the sector's strong, that means everything in that sector is pushing up higher. And then lastly, the last 30% of the move is due to the stock itself. So 70% of the move of your favorite stock has nothing to do with your favorite stock. It's all that collective momentum pushing it higher. And then Nicholas Darvis, one of the, how should I phrase this? Nicholas Darvis wrote this book called How I Made $2 Million in the Stock Market in the 1950s. And of course, that was an incredible sum of money. And he talked about how in his particular strategy, if he saw a sector acting well, he would buy every stock in that sector. Every stock in that sector. Because listen, if the market's pushing higher, if the sector's pushing higher, we got a lot of opportunity in that sector. And then he would just pick them off one by one. If they weren't working, right, if they were going sideways, he'd pick it off. If they started to lose money, he'd pick it off. And he would let his winners run with all this wind at their back. So that's where I'm going with that is how you need to be thinking as well. I want to have everything that I possibly can on my side. And so with Outlier, it makes it really easy because we have 9 different areas to look at. And, you know, you could go through Outlier 9 about 20 seconds on any stock and know if everything you want to see is all lit up, right? So looking at this here, there are 163 sub-industries, 74 industries, 25 industry groups, and then 11 sectors. You want to have that momentum at your back, like Corey was saying.
99. So before that, there was no these are the clear rules on what is a tech stock and what is an industrial stock. We've been inventing the rules of the game in my lifetime. How we measure, track, and what's included in an index, all of this has been shifting and evolving recently. For example, MSCI and S&P eventually adopted what's called free float weighting. So this ignores what are called closely held shares. And closely held shares are ones that are held by a few individuals that are not widely available to the public, maybe the owners of the business. It's sort of changing the rules of the game while we play it. So then when we look back at...
Also, want to add to that, the S&P 500, right? We look at this. This is actually a market cap weighted index. Market cap means what is the price of the shares multiply the number of shares outstanding. That's how you get your market cap. And then there's great websites like this. You can just type in like FinViz map or stock market heat map, something like that. And this will actually show you visually what is moving the market, right? This is probably all of the S&P 500. Yeah, it's the S&P 500 right here, weighted by market cap. The bigger ones like Microsoft, Nvidia, Apple, these are going to have significantly higher weight in the overall move of the market versus the smaller ones like, let's look over here, like FCX, like United Healthcare. Even though United Healthcare is still bigger than FCX, it's not going to move the market really compared to Apple, Microsoft, Nvidia. That's why when you hear about big names going down, like if Amazon has a really bad day or if Microsoft has a really bad day, the whole market has a bad day. Right? Look at how big Microsoft is. It's almost the entirety of the financials over here. like between Visa, JP Morgan, Bank of America, Wells Fargo, American Express, Capital One Finance, MasterCard. Microsoft is nearly as big as all of these combined. Same with Apple, right? It's as big as nearly all of these combined. Amazon is as big as Tesla, Home Depot, and Lowe's combined. I think that's really interesting. And that is actually really a big factor in these moves, right? Now, when you look at a few years ago, the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, right? Let's look, where are they at? Where's Facebook? It's Meta now. It's always going to be Facebook to me. Facebook, Apple, Amazon. Where's Netflix at? Netflix is in the communications. Here, Netflix and Google, right? These are big names, right? If the FANG stocks start going down, then everything's going to start going down, right? Because when they were doing well, the whole market was pushing up higher. So that market cap weighted index sounds great, and it actually is from a long-term investor's perspective. But if any one of these in particular goes down, it could be a huge drag on the market. So let's get back to this.
Incomplete records, of course, the outcomes are going to change, aren't they? And will this trend continue? Will we keep changing the rules? And more broadly, when does the comparison to the past just become a bit pointless? In 1870, when this chart started, horses were still one of the quickest ways for people to travel, unless you jumped on a steam locomotive with an estimated 6,000 horsepower. Fast forward to today, and the Boeing 747 AI, according to AI, is about 100,000 horsepower. It's probably wrong, but all my plane geeks are going to be screwing their faces anyway at me, counting jet engines in horsepower, because it's a stupid comparison. You could line up 100,000 horses, do whatever you want to them, within reason, and they ain't taking off. They're never going to fly. It's a silly comparison to compare the horses.
I really like this channel. This is the first video I've watched. I saw a lot of comments of you guys saying how much you like this channel. Now I see why. I really like him.
To the jet engine. In the same way, is it a silly comparison to compare the stock market today to the one in the 19th century? The dominant sector back then was rail. Today it's tech companies that our great-grandparents would struggle to comprehend. They also wouldn't grasp the size, scale, and importance of the financial markets today. And this idea that the chart presents that you could have just stuck 100 quid in the S&P 500 back then. What does that even mean? Who was seriously buying the stock market in the 1800s? You weren't just DCAing into an index fund, were you? Markets were elitist and riddled with manipulation and fraud. I mean, they probably still are. But one thing is certain, the markets have changed. Over this period, sector and country weights have changed dramatically.
Oh, and not only that, like the S&P 500 as an index didn't exist. In fact, I just watched a video recently. I didn't know this. So Jack Bogle, the founder of Vanguard, was the one who created the ETFs in general. Like that did not exist before. He would combine these companies into one sector ETF or one S&P 500 ETF. And Jack Bogle, like I say, the founder of Vanguard, actually was praised by Warren Buffett. That was the video I watched. It was Warren Buffett specifically praising Jack Bogle, saying, you know, so many more people are wealthier because of Jack Bogle's creation of index funds. So you couldn't even have done that in the 1870s. I don't remember. It was sometime between 1970 and now. I don't know exactly. Maybe somebody in the chat can tell me. Maybe you can enlighten me.
In 1970, a global equity portfolio was dominated by industrials, energy, and manufacturing, with barely any tech. Today, it's heavy in technology. Japan was tiny in the 1950s, it dominated in the 80s, and then it shrank again. And China and other large emerging markets barely featured before the 2000s. At what point do we admit that what markets were back then versus what they are today is like comparing horses to jet engines? So how useful is that for forecasting returns going forwards? I'll admit that this research humbled me. I've sat here with conviction multiple times saying the global stock market has returned on average over 9% before inflation and 5% after inflation for more than 100 years. What I haven't explained, and I will be going forwards from now on, is that much of that return is based on reconstruction, backtesting, and hypothetical data. If you want rock solid market data written in stone, I'd say it's 1990s onwards really for the global markets. So what does all that mean for investors? DMS are clear that markets have produced positive returns for investors, and they continue to show that year after
3.5% returns. The 21st century is now 25 years old. Measured since the start of the 2000s, stock returns have been lower than over the 20th century. How about this? Global equity investors still enjoyed listen, I'm getting hella pissed if I got an annual real return of 3.5%. If I got an annual real return of 3.5%, I would feel like the biggest failure of all time. I certainly wouldn't be enjoying it. No way. That's crazy. And I think that it may go to what he's talking about here, right? That market manipulation in the data to make it seem so much better. He didn't necessarily talk about the attrition, right? Going from 500 stocks in 1870, just hear me out, the example here. Going from 500 stocks in 1870, 6 of those are still around today. So they dropped off the other 497 or 494. And then they added more along the way, right? That's very interesting. Yeah, I bet Pelosi's getting way more than 3%. She's definitely enjoying way more than 3%. Brandon says, what am I going to do with 3%? Nothing. Oh, okay. March 4th, 1957, the S&P was founded, but not the index, not the index. In fact, we're going to have to Google it. Let's ask ChatGPT. When were stock indexes created by Jack Bogle? ChatGPT says, Jack Bogle did not create stock indexes, but did revolutionize creating the first index mutual fund. Okay. Stock indexes were created Dow Jones in 1896 and the S&P in 1957. There you go. That was, I'm going to give full credit to that. Chris P, 1957. There you go, my friend. Jack Bogle, founder of the Vanguard Group, created the first index mutual fund in 1975, which is now the Vanguard 500 Index Fund. Okay, so 1975. 1975 was when you were first able to invest in the market as an asset, as one thing, right? Instead of having to go out and buy multiple shares in all these different companies. In 1975, that's what I meant to say. In 1975, you could go and you could say, okay, I want to buy the market. How do I buy the market? I buy Jack Bogle's Vanguard 500 Index Fund. There you go. Look at that. We're all learning together. Thanks, ChatGPT.
After year. I won't be changing my investment approach, but I think we should be more realistic about market returns going forwards. The US stock market from 1900 to today is believed to have outperformed other markets by about 2 to 3% a year. This is often the reason people say you should just buy the American market. But with that logic, are you falling victim to survivorship bias? You know who the winner is today, so you can project that backwards. This is the same mistake that DMS set out to correct in the first place. If I took you back to 1900 and said, you have no idea what's coming, one of these markets will win more than any of the others. You can either bet on all of them and you'll do okay, or you can just
USA, USA, USA. That's what I'm betting on. USA.
risk going all in on the one that you think is going to win. But if you get it wrong, it might be catastrophic failure. What would you choose? Investing should always be about hitting our financial goals and avoiding catastrophic losses, which I think is the key insight from this. It's nothing new, but I hope this uncertainty about past results really frames it for you. Next time you're on a compound interest calculator like this one, which I've linked below, I made it. It's great. It allows you to add fees and all sorts of things. I pin it as a bookmark for all my compound
Interest calculators are interesting, right? Because that assumes you're going to have a smooth rate of return. In fact, even on his right here, a smooth rate of return of 9% annually. That's really interesting because in my business, right, I've been up 172% in 1 year. I've been up 90 something percent last year. I think it was 91.37 last year. I'm up 55% so far this year in the first 6 months. 2022, I was down 20% that year, right? Compound interest calculators, as exciting as they are to plot, oh, how wealthy I'm going to be in 30 years, not really realistic. I prefer to use a Monte Carlo simulation. Now, Monte Carlo simulation takes your win rate when you're trading, your average win and your average loss, and that plots it out over thousands of different scenarios. And that tells me, where am I going to land? Where this here is just a pie in the sky. I hope it returns this on average. Versus based on my number of trades, based on my strategy that I have control over, right? Where I get in and where I get out. On average, this is the return I can make per trade, right? So basically going from an annual return average to a per trade average. And that tells you, hey, if you make X number of trades, and this is your average return per trade, in theory, you could end up with X number of dollars in your bank account at the end of that number of trades. I prefer that. I feel like that's a little bit more data driven than just assigning a random interest rate, but that's just me.
Needs. But next time you're on one of these and you're planning your future and working towards your investment goal, don't just bang in the average return of the last 100 years. Stress test a range of returns, because the confidence people have in past performance hides.
I actually really agree with that.
The truth of this chart. The further back we go, results start to look less like science and a little bit more like.
We're going to stop it here before I get a copyright strike on that because the music. That was a great video. Oh my gosh. If we still ranked videos, that would have got a 10 out of 10 for me. In fact, how would you rank this video? We're going to do it right now. I personally would rank it a 10. I loved it, right? We learned something. The video quality was outstanding. Oh my gosh. If I didn't have to put out 2 videos a day every day, maybe we could do something like that. But man, very, very impressed. Yeah, everybody's good. No 7s. No. I know. So that was, if you haven't watched our videos previously, this is going back several months at this point. We used to rank these videos and say, okay, how much did we learn? How did we feel about these? And it was, between 1 and 6, and then 8 to 10. Nobody got a 7. And the reason being is that nobody gets a 7 because that's like the cop-out answer. And I see everybody throwing those cop-out answers, right? There was one correct answer. Brandon, it was a 007. Yes, that's what it was. You guys are the best. Thanks so much for hanging out with me this morning. We'll be going to Outlier University this afternoon. Everybody's getting on the school bus. We're the Yellow Dog school bus. We're heading out to school this afternoon. You better be there. Have a fantastic day. But listen, if you're ready to save time, make money, and start winning with less risk, you got to click one of these 2 videos. Elsewise, you're going to lose money. Have a fantastic day. We'll talk soon.